Okay, so a couple quick news items. The jobs number came in about double what was expected. So good news there. On the opposite side of that coin is government jobs are at the lowest point since 1966.
Oh, wow.
Specifically federal government jobs. So all the cuts have reduced the amount of bloat in government so far. And as a percentage of population, it's actually one of the lowest points in history for government versus population. So that's a good sign on getting some of the spending reduced. The other thing is silver. Last time we talked about silver, it was at about 84 an ounce. Today it's at about 84 an ounce, but in between it got up to 121 an ounce. So it
Right.
went up about 45% and came back down. It's resetting a base at about that level, and it looks like we should see it go up again, I would guess, over the next month or two. Just quick news on that kind of stuff. And so we'll jump in. So we have several different topics we're going to be doing this year. Last month we did valuation. Today we're going to talk about high valuation investing. Next month we'll talk about low valuation investing, raising the floor, importance of being on the right side of interest rates, alternative investments, and then the importance of cash. So the timeline of all of these events is, I think, going to kind of align with a very bullish market as we see a lot of liquidity coming into the economy. So I hope those topics become more and more relevant as we go through them. So valuation, how we tell if market is priced high or low. The big indicator specifically with the stock market is the Shiller PE ratio, and we'll look at that again today. Higher value investing. This is our topic for today, how we invest when the market looks expensive. A lot of times when we talk about the market, we talk specifically about the stock market, but there are other markets. So for example, the precious metals market, cryptocurrencies, so other alternative investments that might be inexpensive now in relation to the stock market. So we'll go into that a little bit today. In the next month, we'll talk about low valuation investing. So once things look inexpensive, how do we invest versus what we're doing today? Number 4, raising the floor. This is one of the most important parts of investing, especially if you're at or near retirement, meaning that you can't risk as much, so you can't lose as much because it will greatly affect your income in the future. So how can you continue to get market-like returns with much less risk? That's raising that floor of what you potentially are risking. Number 5, being on the right side of interest rates. Every investment that you have is tied to interest rates. Are you the one earning it? Are you the one paying it? And if you are the one earning it, is somebody else taking your money, like a bank, and earning a higher interest on your money than what you could be earning? So looking at the different sides of interest rates and how to make sure you're on the right side of it. A deeper dive into alternatives such as gold, silver, crypto, real estate, and how they may be affected by different markets. And then finally, cash flow, the importance of cash flow specifically in retirement. Since you're not trading your time anymore for income, you need to have your investments creating that income for you. So that's a quick synopsis of where we're headed. And then just as a reminder, the overall 2026 investing thesis that I put together, assets will likely have a big year this year. Physical assets, gold, silver, copper, real estate, digital assets, Bitcoin, Ethereum, Solana, XRP, and then of course traditional assets, stocks and bonds. I think for the most part, all of those will do well this year. Real estate has a bit of a different story than maybe the rest, in that real estate is, like most things, driven by supply and demand. And the supply is increasing slightly, but the demand is decreasing. And a big part of that is we've had 2.5 million folks that were here in the country needing a place to live no longer here. And so that reduces some of the pressure on the real estate. So I wouldn't be surprised if real estate kind of levels off and or starts to come down. And we are seeing rents come down in many areas, not necessarily here in Southern California just yet. Why will we have the big year? Number one, the Fed is doing quantitative easing. They're basically printing money and buying treasury bonds. Once those treasury bonds are unavailable to purchase, it actually causes investors to move up the risk spectrum. So they start buying things that have a little bit more risk involved, and that drives other asset prices like stocks higher. The Fed, with this new jobs number, the current Fed likely will not be cutting interest rates again. Once we have a new Fed chairman, it is yet to be seen, but we will likely see interest rates start to be cut again. The tax returns on the new triple B or big beautiful bill, we have huge returns coming in, people that are surprised by the amount they're getting in their tax returns this year, which is going to create a ton of liquidity into the economy. So all of that being said, we're looking at somewhere between 3 and 10 trillion in liquidity added to the economy. That, of course, has to go somewhere. And for the most part, I expect we'll see asset prices go up in part because of that. Now, with the stock market in general, because the valuation is so high and continues to get higher, I do suspect we're going to have a correction this year, probably in the third or the fourth quarter. And inflation could get a little higher than it has been. So far, inflation's been held in check, but we could see that start to move with the increase in wages that we've seen so far and the extra liquidity in the economy. AI could slow hiring and immigration policy could protect jobs. So as all these companies start investing into AI, we could see the high-end jobs that are going to a lot of these technology companies slow significantly. Again, so far, knock on wood, that hasn't been the case. And then as we have more folks leaving the country, it creates or keeps jobs available to those who may not be getting the technology jobs that they would have gotten otherwise. So there's kind of an offset there between those two things. And then the Jevons paradox or effect, just as a quick reminder, with the invention of concrete, it was supposed to put a lot of people out of work because the ability to build became much easier and you didn't need as many people to build a house or a building as you used to. But then what the paradox was, concrete was so strong and was able to build structures that were much larger and required more people to build these larger structures. And it actually created a boom in the economy. So there's a chance that we have the same thing with AI, that the jobs that exist currently might get replaced by AI, but it may create a whole nother industry of jobs that we can't even foresee at this point. So that's kind of the thesis for 2026. And then everything that we'll talk about going forward kind of will be determined or looked through the filter of that thesis. Okay, so Shiller PE ratio, we're up above 40.5. You'll see we've only been this high once before in history. That was the 2000 bubble. Anytime we've gotten above this line right here, the 25 marker, we've had a 50% correction at some point. Will that happen again? I don't know. It's possible, if not likely. We have that, the valuations on top of a weakening dollar and basically a failing dollar as far as the amount of debt we have. So there's several balancing acts occurring all at once to try and stabilize this. All of that being said, I do suspect that we will see a correction. I don't know when. Every indication I have is that it will be this year, in the second half of the year, but who knows? Timing is a very difficult thing to do in this industry. Knowing when something is due allows you to invest properly, even if you're early. Okay, so high value investing, how we invest when the markets look expensive. So right now, as we just looked at with the Shiller PE, things are not just high, they're almost at the all-time high for being overvalued. So when the market becomes that way, meaning prices are well above long-term averages, the potential for future returns usually goes down and the risk of sharp drops goes up. So when we talked a little bit earlier about raising that floor, most of you on this call cannot afford to have a significant drop. And so the way we invest when things are like this is we follow a revised version of Ray Dalio's all-weather portfolio. And so basically the purpose of this portfolio is that no matter what's going on in the economy, no matter what the economic weather conditions, whether it's strong growth or slowdowns or recessions, inflation, deflation, higher rising interest rates or falling interest rates, there's pieces of the portfolio that perform well no matter what's going on there. For example, we held silver for a long time and it performed. It was getting 8 to 10% per year for most of the time we were holding it. And then this last year, it jumped up 150%. And at its peak was up over 200. And so that's an example of where we can see an asset that's in a portfolio and it's there for the purpose of being available when things get scary, when people start to fear that the economy is not stable. And so we have all of these pieces, and all of these pieces do not do well all of the time. So when long-term bonds are down in value, I get a lot of questions about why are we holding these bonds when the stock market's going through the roof? And my answer to that question is because they continue to pay you a stable income. And when interest rates go down and the stock market goes down, this is where you're going to see your growth, and it's going to keep your portfolio stable. Your floor is at negative 10% instead of negative 45%. So that's why we do that. That's why we invest the way we do when markets look expensive. So why we use it when valuations are high. When prices are high, future stock returns are typically low. So I think we're coming up on what I would call a melt up, where we're going to see the last few ticks in the stock market. It's going to go up, and it might even go parabolic at some point. And what ultimately happens is everybody who has a dollar leverages that dollar to try and make it $2. And when you build up that leverage into the end of a stock market cycle, it creates this huge crash. And it's kind of a snowball rolling downhill. And to explain leverage, if, say, I own $100,000 worth of stock, but then I am able to take a 50% loan or margin on that stock and I buy 50% more. So now I have 150,000 of a stock. But say that stock starts to go down. So say it goes down by 10%. My 150,000 now goes down to 135,000. I still owe the 15,000 on the 150 from the $50,000 loan. So I need to sell stock to cover that 15,000. And when you sell a stock, it starts driving the price of that stock down. Once you have more and more people selling, it pushes it down more and more and more. And then you have more people who have margin calls and they have to sell. And so it just becomes a worse and worse scenario. We just saw this recently in the cryptocurrency market. We saw same with silver. Actually, I'm going to use silver as an example because that's an easier one. So on silver, we saw it get up above 120 an ounce. Somewhere in there, a very large seller put a limit order in at, say, 125 an ounce. And that was visible to the market. So somebody is selling a very large position at 125. So everybody wants to get out before that starts. Well, it's market manipulation. The big seller just put that there to actually drive the prices down. I don't know if they are short, meaning they're betting against the price of silver, and this will give them an opportunity at a lower price to get out of their short position. But ultimately, what they're doing is manipulating the price down by putting that limit up there, because everybody who sees that limit is like, I need to get out before that price, otherwise I'm going to miss my opportunity. And so everybody sells out. Once that starts to happen, you have all these people who leverage their positions, they have margin on their silver, and it causes margin calls, causes people to have to sell their silver to close those positions, and that selling drives the price down. I think we've, if not completely, for the most part, cleared out the shorts on the silver position. And that's why we're seeing it level out between about 75 and 85. And eventually we'll have that start to come back up again. But what we see is these market conditions that ultimately are manipulated. And if you're not a long-term holder and or you've leveraged yourself to an extent that you're taking on more risk than you can stomach, it's a bad scenario to be in. And so when we see that melt up in the stock market and we see the leverage increase in the market, that's just a big flashing light that lets us know, okay, the bottom's or the top is coming and we're going to see a drop here pretty soon. So instead of being all in stocks, what we want to do is balance risk more evenly across asset types. So some of those might be bonds, commodities, alternatives, gold and silver being examples of both commodities and alternatives. Some of the cryptocurrencies we've discussed. In fact, right now is a fantastic time to be buying some of those cryptocurrencies at 40% discount from where they were even a couple months ago. Something to consider there. And it's not about getting out of the market. It's about spreading that risk into multiple baskets. So high value investing, how we invest, basically what we want to do is, depending on the market environment, we fluctuate in how we invest. So prices keep rising. When prices keep rising, we want to participate through the gains, and we want to also at the same time start to take those gains off the table. And we want to avoid some of the big swings. So for example, in the all-weather portfolio, typically we want to have about 25% tied to the stock market. If the stock market goes up by 50%, you might be up to 30% of your portfolio. And so we may want to pull that 5% off the table. Now, if prices fall sharply, and we're fully invested, that could delay our goals. So for example, I'm talking to somebody tomorrow, as a matter of fact, who just retired. His 401k is invested 90% in stocks and 10% in bonds. And he's done incredibly well over the last couple years. And we get to have a hard conversation about, hey, I understand you've done quite well on this. However, if we keep it that way, are you willing to have potentially 25 to 50% less income over the rest of your lifetime? No, absolutely not. So what do? We create a smoother ride and keep that plan on tracks. So we may give up some upside in the short run, and we may give up some upside historically, meaning we might be getting 9.5% instead of 11%, but we're avoiding those big downs. And then, of course, there's always going to be economy surprises, black swans. And if you're, when the market is overvalued, if you're invested in a way that you can get caught off guard, you can't go back. So for example, if the market drops 50%, you need 100% return just to get back to where you were. So we can't afford to do that. We can't afford to take those risks, especially if you're drawing off those assets. But with the all-weather, it's built to adapt. It's built to perform no matter what's going on. Any questions about any of that? I know that was a lot of words. I'm hoping the examples stuck a little bit. Any questions? So my big takeaways for today, for the next 3 to 5 months, is I think crypto is at a low point or near a low point. And if you think about, personally, I have hundreds of thousands of shares of XRP. for example. XRP, I liked it at $2.50 a share, $2.50 a share. It's now at $1.40 a share. So it's a smoking deal as far as I'm concerned. So this is an opportunity to start getting exposure. And the way you do that is actually through an XRP ETF, where they hold it, you just hold the fund, and the fund appreciates and depreciates according to the price of that cryptocurrency. You also have what are called treasuries. So for example, MicroStrategy is one of the big Bitcoin treasuries, actually the biggest Bitcoin treasury companies out there. And it was trading at 450 last year, and it's at 130 today. Opportunity to take 1 or 2% of your portfolio, buy something like that has potentially a huge future at a low price, and you can afford to lose the 1 or 2%, but it could add percentage points to your returns each year, especially getting it at the right prices. And then silver, again, specifically with silver, the story on that is basically over thousands of years, we built up a pile of silver. It was only good for jewelry and coins. And then about 50 years ago, we started using it within technology. Now, the demand for silver, the annual demand, is more than we're able to mine. And the available liquid supply is way down, less than a year's worth of liquid supply. And what that means, that's why we saw the price jump up to 120, and why I think we're going to see it jump up to 150, 160, and maybe beyond that. So another opportunity to get something, well, relative to last year, it's not cheap, but I do believe relative to where it's going, it is inexpensive at this point. So those are my takeaways.
Yeah, man, I got a question.
Sure,
Is
Phil.
crypto going to be the new currency in the future?
I think it certainly will be in some ways. Many of the European countries are creating a digital currency. In many ways, the dollar already is a digital currency. So I don't know exactly with that. But as far as the underlying technology of crypto, which is blockchain, it's a much faster, more secure, simpler way of keeping track of things. So it's more secure in that the blockchain is basically a ledger, a list of transactions that occurs on a network of computers. So every computer that's on that network has the ledger. So currently, if you're working with Bank of America, they might have 2 or 3 main servers throughout the country. If somebody hacks one of their servers and says, Phil's money is my money, it might be difficult to track that down and figure out what happened. But within the crypto ledgers, because it's a network, every single computer has it. So you might be able to hack one computer and say, this is the transaction and Phil's money is my money. But the rest of the ledger actually verifies that transaction and confirms that it's wrong and would correct it. So in that way, it's much more secure. As far as replacing money, I don't know that we'll replace any currencies with crypto, but a big use case is the ability to go from one country to another. Meaning, let's say Spain is sending $1 million worth of their currency to buy Coca-Cola. And right now what happens is the euro or whatever currency they're utilizing needs to be exchanged to dollars, or they need to be holding dollars. And then that gets sent through the SWIFT banking system, which may take up to a couple weeks for the transaction to settle, and generally costs about 2%. So on $1 million, you're talking $20,000 for that transaction. Under new systems, that same transaction, whether it's coming from a different currency or the same currency, will take about 3 seconds, literally 3 seconds, for it to be converted and show up as a completed transaction in the other account, and will cost somewhere around $200. And so it creates a much less it creates much less friction within the economies. And it also means a lot of these companies and countries don't have to hold these huge accounts of different currencies to be able to make these transactions. So you have money that's just sitting on the sideline, not earning interest to be able to make these transactions. Now they can hold $0 or €0 or whatever it be, and that money can be put to use, which helps the entire world economy. It kind of greases the wheels of the economy. So I foresee that being a big change in money in general, in banking. That's part of the big argument that's going on about the Clarity Act and getting that approved. Banks are greatly opposed to some of these things. So we'll see what happens with that. Ultimately, it's better for the consumer to have the availability of these types of currencies and these blockchains. So I think in many ways, that's how we save the dollar. I think in many ways, that's how we keep not only the US economy, but the world economy growing. I know that was a lot of words for a fairly simple question, but
Oh, no, it's
okay.
so yeah, I was kind of wondering because I read that someone lost billions of dollars on a crypto exchange.
Crypto definitely
Oh,
went
yeah.
down in value, just like any investment. You don't lose money unless you sell it, or it goes to zero, which don't get me wrong, there will be a lot of cryptocurrencies that don't exist in a few years, but it's pretty certain which ones have um, proven their worth and kind of made it certain that they'll be around 5, 10, 15 years from now. So as long as you stay away from the meme coins and stick to maybe the top 5 or 10, I think you'll be in good shape.
Okay, thank you, Matt.
Yep. Any other questions before I lose my voice?
Bye
See you
bye.
next month, everybody.
Thank you, everybody.
Bye.